Hello ladies and gentlemen, welcome to today's webinar. It is Friday, the end of the week. Today's topic that we will have a look at will be rules of position sizing. As I mentioned the last time when we spoke about the timeframes, indicators and different styles of trading, right now it's time to take a look at what is the appropriate style of managing your risk, whether it's from a different perspective like fixed position size, whether it's from a perspective of the so-called Martingale position sizing, whether it's the fixed fractional position sizing as well as the last two, which are the ATR based position sizing and the risk-based position sizing. Now, for every each and one of these, which you see in front of you, I have a few details. First of all, I will mention those that are highly inappropriate for most of the trading accounts. They're considered extremely risky. The position sizing in general refers to the dollar value of your trade. That, of course, can also be used to define the number of shares or contracts or a position that you will trade. It is very common, of course, for example, for most of the new traders to start with the so-called mini lot size. Of course, after time, and of course, if the system that you might be using at this time provides successful trades, the trader himself may trade more than one contract or a position at a time, therefore increasing potential profits but also maximizing losses. Certain trading plans as a structure may call for additional contracts to be added if a certain profit is achieved, or if you are sustaining some losses, you should be able to diversify it by any other way. Regardless, of course, of what I mentioned so far, the rules of position sizing should be clearly stated in your own trading plan. Therefore, the first type of position sizing we will have a look at is the fixed position size. This is probably the most widely used position size technique. A trader just uses a fixed lot size, for example, one standard lot, on all positions he makes. The technique, however, is simple to implement both manually and with an expert advisor if you wish to use one. It doesn't require any calculations. That's as simple as it can get. The problem is that it's very limited and can be quite dangerous if, of course, that particular fixed size is too high. The income, let's have a look at the income for traders that are using this particular position sizing style. Doesn't rise with the growth of the account balance. So the trader isn't earning profits that would be earned by employing some other position sizing models. And this is proven to be true. When a trader sets a fixed position size to some large amount compared to the account balance, there is a danger that the account will get wiped out in case of continuous losing streak. While, of course, this type of position sizing offers a very fast build-up of balance in the beginning and becomes less aggressive at the end when you get used to it, I would not recommend this position type of sizing system for any trader with a real account, unless, of course, you have unlimited funds and resources and you can afford to trade with a fixed lot. However, this also should be systemized according to your preferences and risk systems. That's why the next particular position sizing system that we'll have a look at is the Martingale. Before we take some calculations on the next ones, if we have a look and we think that the fixed position sizing is dangerous, then of course Martingale position sizing is definitely not for any trader that considers the previous type of position sizing system dangerous or risky. The main rule of this particular technique is to increase your position size as you take losses. This is what the system focuses on. It's derived from the so-called Martingale gambling system, which of course involves doubling your bet every time you lose. It is still popular, of course, among some gamblers and forex traders that consider the forex business as a gambling, which of course it's not. This system offers a very surefire money-winning method for a trader with, as I mentioned, infinite account balance. But unfortunately, let's have an example, even George Soros doesn't have an account which is infinitely big. In the forex market, ladies and gentlemen, Martingale positioning sizing is somewhat popular, particularly because it offers a comfort of potential revenge on the market, and it basically means doubling your size after a loss in a trader's hope to get back what has lost, and of course also gain some profit at the end, at some time. In reality, however, let's have an example. I've seen this happening many times, as well as I've been testing it on real accounts so many times throughout the years without even knowing that this is a particular Martingale position sizing system, which of course that was more than 15 years ago, but still a streak of 5 to 6 losses in a row usually leaves the trading account totally empty. And why is that? It will follow up on the example that I'm going to give you right now. Let's say you're using one lot as a position size and you've lost $1,000 on a trade. Your next position size will be increased to 2,000. Lots are doubling your potential profit to cover your previous losses. If that one is a loss too, you double the position size again to 4 standard lots. Then you lose 4,000, and so on and so on. So basically, so far you're already in a negative $7,000 or $8,000 from only 3 trades. That's why Martingale position sizing system is no fit for anyone that is willing to trade, to take any risks on the market. However, the next two, I'm going to call them two. This is the fixed fractional sizing, position sizing, and the risk-based position sizing are absolutely suitable for most of the trading accounts, for most traders with different, should we say, trading systems. The ATR-based position sizing is more like a second possibility to for the fixed fractional position sizing, basically because it's an addition with the ATR-based indicator for a better calculation of a lot size. How we can do that? We'll have a look at the next pages here in front of you. There's a few calculations that I've made specifically, but first of all, follow up is along with me. The fixed fractional position sizing is often called the reverse Martingale, because here a trader increases position size after a winning trade, and decreases it after a losing trade. The idea, however, here, ladies and gentlemen, is to minimize the risk of wiping out your account and to increase the exponentiality, the income, in case of continuous profitability of the trading system that you're using at the moment. Although it's probably the most effective and safe position sizing system for forex traders, unfortunately, it also has its own disadvantages. The biggest of them is that it works poorly with trading strategies that often involve losses after huge wins. Such positions would be seized and then increases the losses, decreasing the overall strategy's performance. So you see, it is quite important to remember that a gradual buildup of an account is by far the best so far. Let's have an example. If you have an account of $7,500, just as an example, then you decide to set your position size to 0.01% of your account size. That definitely means that the only way to calculate this is to find out in percentage how in the 0.01% out of $7,500, how much this is in US dollars, and then divide it on 100 so you can get that lot size, which means $750 divided on 100 gets to 0.75 lot, would be appropriate for a volume to take. And as an example, if the position that you've taken with 0.75, your profit is 500, don't get these profits as any kind of, take profit targets or whatever. It's just a profit so you can calculate further and understand how this particular position sizing works. Then you take the whole $8,000 balance and find out how much is the lot size with a risk of 0.01%. That would be 0.8 lots, or 0.8 of a lot. In case, of course, of a loss, as you can see on the right side, it would be $500 loss. That means you have about 7 grand account. And then, of course, the percentage 0.01 is equal to 0.7 lots. By using the same simple formula, you can see over here, you can calculate how much is the lot size by using the fixed position size system. Now let's have a look at the ATR based position sizing. It is important to remember that this actually, it is just an additional rule for the fixed fraction position sizing technique, but of course can be used with any of the following that you might find later on, which is the risk-based position sizing. However, it is best working with the fixed fractional position sizing. The system, ladies and gentlemen, involves position size normalization according to the value of the average true range indicator. Now, for those that are already familiar, you know that this is just a curve, like a moving average, hovering between levels. The only way you can measure the current level is to use the crosshair and to see where the ATR is standing at the moment. So the ATR shows the volatility of the market, something that we spoke 2 sessions before this one. We spoke about volatility. I suggested some indicators that measure volatility. Extremely useful. The ATR is one of them, which increases a smaller position size that would be advised, because volatile market has a higher chance of pushing the trade out of its planned way. All right, basically because it's extremely volatile, it starts getting choppy, and gaps also can occur. As ATR decreases, a bigger position can be opened, as there is a presumably less probability of a price spike to hit your initial stop loss. So this position sizing add-on, should I put it, is useful for the trending forex strategies, and can be harmful for range trading, for example, because spikes can be useful to take profit in this case. As you know, there's also a sideways range market, which you can trade it between upper and lower level of range, which means most of the traders actually, not most, but should we say 50% of the traders consider this as an extremely profitable way to trade. I am also one of them. Sideways range is extremely reliable based on the fact that the range can go for as long as it's broken, and there are various of indicators which you can combine to use with this range trading. However, we are mostly focusing on the trending markets, basically because it's much more safer to trade. Of course, the relative profit compared to the sideways range trading is quite lower, but there the risk decreases as well. Speaking of the ATR-based position sizing, we'll have a few examples here. Follow me on this one, if you please. Your account balance, for example, is, let's have an example of a $10,000 account, and you decide to set your position size to 0.02% of the account size. You are, let's say, trading the Euro USD, and consider, just as an example, I'm getting a level of ATR of 0.001 as a normal value. The next thing we have to do is calculate the fixed fraction position size, as we mentioned earlier. Let's have a look how this works. This is the formula, and we're implementing it over here. We find out the size of the lots. Then the current ATR is, let's say, a level of 0.00221, and here is your formula. 2 lots, you divide it on the result between dividing those 2 ATR levels, and in the results you will get 0.905 as a lot size. So this is the so-called equalized size of position. Of course, it's a bit more complicated, a bit more advanced using the ATR. However, it's much more accurate by using this ATR. There are different formulas as we presented. It's a good way to mention that for those that have been with us for a long time. You've probably guys noticed that we have several different strategies for risk management. Those that we actually present in the basic webinar trainings, those are simply formulas, mathematical formulas based on your account balance size, based on 5 to 10% risk of the whole portfolio, and of course you can divide this to all of your positions. But here, as a matter of fact, we're speaking of a bit more accurate and more sensitive to those that are extremely fixed to have everything extremely accurate, like down to the tenths of a pip. Therefore, you have your 0.905 lots. However, let's continue with the example. In this position, for example, wins you about $3,000, then your account balance is 13,000. Then the same method shows you with this particular balance what should be your lot size. You see, every time the lot size increases. Here you had 2 lots, now you have 2.6. That means your position size is getting lower and lower, based of course on a different ATR level. So the higher the ATR level, the riskier the position can get, the lower lot size you should get. And here is equalized between 0.4 of a lot and 0.5 of a lot, based on the calculations of 0.4626. If you have a calculator close nearby to you, you can just check those numbers and see how they fit. Also, I like to mention that this particular method of position sizing is rarely used because it's taking a little bit more time, especially for those traders that are used to trade on lower time frames, like 5 minutes, 15 minutes, 30-minute chart. You know that volatility there could change from high to low is in a matter of minutes. Therefore, the level of the average true range, which is the ATR, can get higher or lower depending on the volatile market. This method to adjust position size is extremely adaptive, however, but as I mentioned, due to the amount of required calculations, is better used with automated Forex expert advisors rather than manually, because if you have it as an input data to your EA, then the robot is actually getting these calculations instantly without you using pen and pencil. But of course, it's quite good to use with larger time frames where the volatility is lower, such as 4 hours and above. And the final risk management sizing system is the risk-based position sizing. This is the one that is used much more frequently. It's based on your account balance, the risk that you are willing to take, and it's much more common among traders which are more conservative to their account balance, and of course are using something between 30 to 1 hour chart time frames to trade. So this one, this particular position sizing system is also in addition to other position sizing rules, and as I mentioned, is more popular with the fractional position sizing too, where you can combine this one, combine it of course with the ATR based position sizing. While of course usually a forex trader bases the position sizing solely to the size of the account here, one would also apply the size of the stop loss of the particular position. So this one is the one that we actually use as in our basic trainings. Here you might see it in less detailed explanations because I have to mention it in addition as a rule. The main idea, ladies and gentlemen, with risk-based position sizing is to limit the potential loss to some fraction of the account balance based on that stop loss. For example, the one that you see in front of you, you have an account balance which is $10,000, and your stop loss, for example, is 40 pips, and you want to risk no more than 1.5% on your next trade, which is, let's take the same example of the Euro USD. Calculating the maximum risk in dollars is the essence. So taking that $10,000, the 1.5% out of this balance will equal to $150. 1 pip, as we already know, 1 standard pip is worth about $10 on one standard Euro USD lot. By having this particular example, calculating the position size is dividing the $150 of 1.5% of your 10K account on the result of the 40 pips multiplied by $10, which is 400. So if you divide 150 to 400, you will get a result of 0.375 lots, or you can choose something in between 0.3 to 0.4 of a lot. This is basically the final position sizing rule. There are not many. That's why today's webinar, ladies and gentlemen, is relatively half the time shorter than the last time, which I took somewhere more than 1 hour and 10 minutes of your time. The bottom line, ladies and gentlemen, here is because using an appropriate position size is often the difference between long-term success and the most important short-term failure. When you're using a position size consistent to your preferred level of risk, your fear levels drop, your error rate falls away, you start noticing fresh aspects of that particular market behavior and your trade behavior that previously you fear had hidden from you. So you see, choosing the right position sizing method according to your style of trade leads to improvement in your trading system, a higher reward to risk ratio, and more profits, which is obvious. To get to this circle of more confidence, less fear, more improvements, you need to derive an appropriate position sizing system. Choose one of those that I mentioned so far. Pretty much they don't exist any that are actually worth taking under consideration. When you have the fixed position size, the Martingale position sizing, those two fall out automatically if you are not a gambler type of person, or if you are, for example, a conservative trader or a little more risky type of trader, which of course you can implement higher percentage of risk in any of those systems. Why I'm using 1.5% for example here is because 1 to 1.5% is pretty much the lowest risk you can actually get on an account of any type, regardless of what the size of the account is. Basically, at the end of the equation, the dollars are less and less if your account is smaller. But then the reward risk ratio is improved in your trading plan. And this is the next step you need to take under consideration. The next time, ladies and gentlemen, this would be next Wednesday, we will have a look at entries, proper levels of entries. Most of all, we will have a look at trade filters to create trading rules. So our next step is creating trading rules, entry points, and after that, next Friday, we will have a look at the exit rules. This will be, of course, for the end of this month of webinars. However, I would like to mention here, for those that are wondering why the next portion of webinars of the final 4 particular topics would continue from the mid-August until the end of the month of August. It's pretty much because I'm taking some holiday off. I will not be at the office. However, for those that are trading with me and they're still here at the webinar, I would like to mention that during that holiday I would pretty much be on the coastline, but that doesn't mean I will not be able to be reached for any extreme circumstances. So have it in mind, you have my contact details directly in my signature. Just dial the extension number so you can get directly to my office telephone number, which of course is connected to my cell phone, and I will answer immediately and help you with everything. I am traveling, of course, with 2 additional monitors and a laptop, so everything that I can do from the office, I can do from my boat. Therefore, today's session is completed. Thank you very much to everyone that joined us today. If any questions occur, please refer to our support department at GDMFX.com, webinar at GDMFX.com as well. Thank you very much for joining us. I'll see you next week. Bye-bye.